So it's time for another fresh business owners corner video. And in this edition, I want to talk about the difference between stock sales and asset sales. If you're someone who's approaching a transition out of your business, you have a stable entity that you think is worth something that you want to sell, well, you need to know the difference and you need to know why you're very likely not going to find a buyer for your stock. These two types of sales have big differences from a tax standpoint. For a buyer, if they buy the shares of your company in a stock sale, they fork over the cash for your company, and then that's basically it. They have no depreciation benefits from that purchase whatsoever. It's not really a deductible expense. But the alternative, of course, is an asset sale where they're not buying the shares of your company or the organization, the entity itself. They're buying the assets and the contracts and maybe the goodwill and everything that comprises the contents of your business, but not the shell, not the entity itself. Because when a buyer purchases the assets from you, they're able to depreciate those assets over time, which is very helpful from a tax standpoint. If I had the choice of one, I'd always want an asset sale. The other reason is that buyers don't want the liability that you hold in that organization. They don't know what might have happened last year or a couple of years ago. They're doing as best they can to figure out what your business is, what's inside of it, what it's worth, and what the risks are from a purchasing perspective. And a lot of that is uncovered in the due diligence process. But there's always this question mark of, if I'm buying another business, is there some ticking time bomb inside that business that is going to expose me to a whole bunch of liability? And when you buy the assets of a business as opposed to the stock, you're just removing the assets out of one organization and moving them into your own. You're not exposing yourself to that risk. So for that reason, something like definitely north of 95% of small business transactions, maybe even as much as 98 or 99%, are all asset sales. Purchasers flat don't want your stock, they want your assets. And if you're going to command a better amount for your business, if you're going to command the most value, it's probably going to be structured as an asset sale. So for that reason, when you're starting to think about moving down this path of selling your business, well, it's probably best to assume that it's going to be an asset sale, because unless there's some unique circumstance coming up, that's what buyers are willing to pay for.